Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. In the dynamic world of investments, knowledge is power, and nowhere is this more evident than in understanding the critical disparity between qualified and non-qualified dividends. Today, we're diving into the exciting world of dividends and taxes. Now, I know taxes can be a snooze fest, but trust me, understanding them is super important if you want to make the most of your dividend income. Many investors tend to fixate on the dividend yield, disregarding the broader tax implications. So, let's explore how dividends are taxed, examine the various tax brackets, and use examples to provide greater clarity. Additionally, we'll explore strategies for minimizing tax obligations by utilizing tax-advantaged accounts. Let's start with qualified dividends, which are the more familiar type. These dividends refer to payments made by a company to the owners of its common stock. Essentially, they are a share of the company's profits distributed to its investors, acting as a reward for holding onto the company's shares. On the other hand, non-qualified dividends are dividends that do not meet the requirements set by the IRS. There are a few reasons why this may be the case. 1. The dividends may be paid by foreign companies that are not part of the Comprehensive Income Tax Treaty with the United States. 2. The stock may not be readily tradable on established U.S. securities markets like NASDAQ or the New York Stock Exchange. 3. Non-qualified dividends can arise from certain U.S. entities such as real estate investment trusts, also known as REITs. REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. However, since their income is derived from rental income or capital gains, it does not qualify as a qualified dividend. 4. Dividends generated from writing call options, like covered call ETFs, are also considered non-qualified dividends. These ETFs distribute dividends to investors using income generated from selling call options, which is classified as regular income. Another aspect to consider is the minimum holding period required by the IRS to qualify for lower tax rates. To benefit from the lower tax rates, you must own the stock or ETF that pays dividends for more than 60 days within a specific 121-day holding period. This rule prevents traders from exploiting income tax advantages on stocks held for only a few days. The key difference between qualified and non-qualified dividends lies in how they are taxed, and this is where it becomes particularly intriguing. Let's start by focusing on qualified dividends. Qualified dividends are subject to the same tax rates as capital gains, which are divided into three brackets: 0%, 15%, and 20%. The specific rate depends on the investor's taxable income and filing status. Filing status refers to whether the investor is filing as a single individual, married and filing jointly, or as the head of household. Let's take a look at the current tax rates for qualified dividends in 2023, based on taxable income and filing status. For single taxpayers earning up to $44,625, there is a 0% tax rate on qualified dividend income. If the income falls between $44,625 and $492,300, the tax rate is 15% for qualified dividends. It's worth noting that this income range is quite significant and offers substantial benefits. For those earning over $492,300, the maximum tax rate on qualified dividends is 20%. It's important to remember that higher earners may also be subject to an additional tax called the net investment income tax. This tax applies to individuals earning over $200,000 or married couples filing jointly earning over $250,000. It imposes an extra 3.8% tax on dividend income. For married couples filing jointly, this threshold is doubled for the lower limit but not for the higher limit. Head of household filers have slightly more favorable tax thresholds. For those who may be unfamiliar, head of household is a filing status for taxpayers who are unmarried but provide support to qualified dependents, such as a child or an elderly parent. As you can see, the tax rates on qualified dividends are quite favorable. By the way, subscribing to my channel would be a great idea. If you could give this video a thumbs up for the YouTube algorithm, I would truly appreciate it. Thank you so much. Let's move on and compare these rates to those for non-qualified dividends, also known as ordinary dividends. There's a significant difference as ordinary dividends are taxed at the same rates as regular income tax. Compared to the tax on qualified dividends we saw earlier, the first thing to note is that for non-qualified dividends, there are more tax brackets set with higher tax rates. For example, if you are single and your income is between $250,000 and $400,000. If your dividends are treated as ordinary income, you'll get taxed at 35%. But guess what? If those dividends were qualified, you'd only owe 15% in taxes. That's more than double the tax rate. If we compare the tax brackets of qualified versus non-qualified dividends, we can see that qualified dividends are taxed at a maximum tax rate of 20%, while non-qualified dividends can skyrocket to a mind-boggling 37% tax rate. So while many investors focus on the best strategy to generate return or dividend income, it is equally important not to overlook the subtle yet very important tax implications of such strategy. Now that we've got the tax jargon down, let's look at an example that compares the after-tax income of different types of dividend ETFs. In this simplified version, we are going to compare after-tax income from SCHD with that from JEPI. Both SCHD and JEPI are very popular ETFs that generate handsome dividends for investors, and we have talked about them in 2 separate videos. Feel free to check them out here. As of this video, the dividend yield for SCHD is about 3.6% and the yield for JEPI is 10.4%. One big difference between SCHD and JEPI is that JEPI relies on writing covered calls to generate income. As we learned in this video, income generated from writing covered calls is non-qualified dividend and would be subject to a higher tax rate. Let's assume you invested $10,000 in each of these ETFs. Imagine you're an individual earning $200,000, which places you in the 32% tax bracket. If you invested $10,000 in SCHD for 1 year, you would receive $361 in dividends. Because dividends from SCHD are qualified, you only need to pay 15% on the $361 from the dividends received. So after tax, you will get $306.85 you can either take out or reinvest back into SCHD. Now, if you invested $10,000 in JEPI, you'd enjoy $1,040 in dividends. Because the dividends from writing covered calls are not qualified, the $1,040 income is treated as ordinary income and gets taxed as such. Because your income is in the 32% tax bracket, your after-tax income is $707. So while JEPI generates much higher dividend income than SCHD, a larger portion of that also gets taxed away. Is there a way to minimize taxes paid to non-qualified dividend income? The answer is yes. The most crucial step you can take to minimize taxes on your dividend income is by utilizing tax-advantaged accounts. These are the golden ticket to tax savings. We're talking about the IRAs and Roth IRAs. First off, let's talk about traditional IRAs. These accounts are funded with pre-tax dollars. They offer you the benefit of tax-deferred growth. In simpler terms, you won't pay taxes on your dividends until you withdraw the funds in retirement. So you can put all of the dividend income earned back into reinvestment to grow your portfolio before retirement. Next we have the Roth IRA, a true hero in the tax realm. With a Roth IRA, your contributions are made with after-tax dollars. That means when you retire and start withdrawing those funds, they'll be completely tax-free. It is the best tool you can leverage to grow your retirement fund investing in ETFs like JEPI. And that is a wrap for today. We've covered quite a bit in this video. Thank you all for tuning in. I know it was a lot to digest, but I appreciate you sticking around. Until next time, please subscribe and like this video. Keep those dividends rolling in, and I'll catch you in my next video. Take care.